got to do it the same way we did it with commercial airline travel. You know, we're really almost in the barnstormer phase.
Our ultimate goal is to achieve complete carbon neutrality by 2050. In order to hit that target, we must make our new cars all non-gasoline by 2040.
Well, what we're seeing more so internationally today, I describe them as short cycle barrels.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 21st of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Stocks shrug off Monday's rout with the S&P 500 posting the biggest gains since March. European equities lurch higher for a second day. Halting the exodus, more senior bankers leave Credit Suisse as JP Morgan dangles $50 million of stocks rights to keep Chief Executive Jamie Dimon for another 5 years. Plus, Jeff Bezos blasts off to the edge of space, then celebrates landing by giving away $200 million. We'll bring you our interview with the Amazon chief executive. So first of all, let's get straight to the markets. And good morning, everyone. We're Wednesday, which means that we've made it halfway through the working week. Buy the dip energy is out again in full force as stocks continues to rebound from Monday's losses. Now, the causes behind the drop remain. The fears over the recovery amid the spread of the Delta variant sent Treasury yields to their lowest since March, and they're now holding just above 1.2%. Speaking this morning to our Manus Cranny, the Julius Baer chief executive, Philip Rickenbacher, said it was dangerous to expect a smooth return to normality.
We will be seeing, I'd say, vastly diverging patterns over the next 12 to 18 months. There will be some countries with great recovery rates. There will be others that will struggle much more. Maybe those who have been running more containment-based strategies will have a harder time getting out of this. I think, again, this is not over, and let's not chart a straight line.
So let's discuss markets, inflation, and the recovery now with Sir Howard Davies. He's chairman of NatWest Group. He's also former director of the London School of Economics and was also the first chairman of the UK's Financial Services Authority. So, Sir Howard, thank you so much, as always, for joining us. If you look at the markets, and you make us smarter on markets and politics and the crossover between the two, but if you look at what the market is worried about, a lot of the focus is on inflation. If you look at wages of bankers, frankly, of cappuccinos also in London, prices are going up. Can we really look through it?
Yeah, I'm somewhat on the side of those who think that we may well have an incipient inflation problem. The Bank of England is, by majority on the Monetary Policy Committee, reasonably relaxed at the moment, say it's a transitory phenomenon. And they seem to be resting a lot on the fact that inflation expectations have not gone up. So if you ask people what they think, they still think inflation is going to be low. But I guess I have a long memory on these things, and I recall that when the bank became independent in '97, and I was there at the time, that it took a long time for people's inflation expectations to adjust downwards. Although the bank had an inflation target, 2.5% as it then was, they kept saying that they thought inflation was going to be 5%, because that's what their experience had been. So at the moment, I think if you ask people what they think inflation is going to be, they're heavily influenced by the fact that we've had a very low inflation period for quite some time. So I don't attach as much weight to that. And I see quite a lot of bottlenecks in the economy. And I see quite a lot of attempts to bid wages up. I mean, we've seen what's happening in the NHS, for example. I'm not saying they don't deserve it, but you know, the government offered 1, now it looks like it's 3, and they're asking for 4. So I do think that there is a risk that inflation expectations rise and that we get some domestically generated inflation, as well as what we're currently doing, which is sort of importing a bit of commodity price inflation, which I guess you would look through.
Yeah. So Howard, does NatWest Group feel under pressure to actually pay bankers a little bit more? We're seeing it from from a number of European banks, and then we had the survey today also saying that workers in London are expecting some £5,000 more just to get back more in the office.
Well, when you say bankers, that's usually a pejorative phrase when a journalist uses it. There are pockets of our recruiting which are difficult, and particularly in certain IT areas. And of course, bankers, by a lot of, probably the majority of our staff are actually people with an IT background of some kind or another now. So we are seeing some pressure in that area. I wouldn't say we were seeing it sort of across the board in bankers in London. I don't think it's got to that point yet. Although there are other pockets like lawyers, where wage expectations appear to be rising, and that might spread more broadly in the economy.
Is there anything in the UK economy right now that makes you worried? I know there's been a lot of talk about the housing market and whether there's, something that actually could turn sinister.
I guess I don't worry especially about that. If you look at the financial stability report last week that the Bank of England produces every quarter, they struggled to find things to worry about in the financial system. The proportion of mortgages at high loan-to-value rates is actually quite low, and the affordability of mortgages is, in fact, quite high, depending on which way you look at it. I mean, in other words, as a percentage of people's earnings, mortgage payments are still relatively low. There are certain companies that have taken on a lot of debt in the recovery, and there are some companies that look quite highly leveraged, and I guess we can all know which sectors they're likely to be in, the sectors that are particularly affected and still are affected in travel and hospitality and bricks and mortar retail. So there are some worry areas there, but overall, I'm not particularly anxious. Consumers have got a lot of money. They have saved a lot during the recession. They're beginning to spend it, but not at an extravagant rate. So actually, the bank found it difficult to find enough things to worry about.
Sir Howard, where are we now? So we're July 21st. Where are we in the pandemic? Here in the UK, we've reopened. A number of people are also being pinged to stay at home. So I don't know whether that affects the possibility of some of your branches having to close down because you just don't have enough staff. But overall, are you as optimistic as you were, 6 weeks ago that we're on a recovery path, or is the way out of this now more uncertain?
Well, I must say, I thought that your interview with Mr. Rickenbach of Julius Baer, I thought he was absolutely right. I think it's going to be a bumpy ride because I suspect we'll take, 2 steps forward and 1.5 steps back as we come out of this pandemic. Because, the pingdemic, a word we didn't even know, you and I wouldn't have known what it meant 6 weeks ago. That's now a thing, undoubtedly, and it's not affecting us in our central operations so much, but you're right that some branches are struggling on staffing. And I think that we will go back and forth a bit. The messaging from the government is a bit complicated, and I think many businesses, and we're one, are not rushing people back to the office at present because the risks of having people in and then getting everybody pinged and having them out again are so high. So I think you'll find businesses are quite cautious about going back to, quote, normal, and that normal will probably be a bit different from the normal we saw before. So I don't think we're in a straight line recovery.
How different do you think the new normal will be?
Quite a lot in some areas, less in others. I do think that the days when 2,500 people walked in through our office door on Bishopsgate at 8:30 and walked out again at 6 o'clock, I think that's gone. We are looking at having a minimum expectation of a few days a month that people will definitely have to be in the office, and then it will vary by teams. But I suspect there won't be that many people who are doing 5 long days in the office, aside from some of the trading areas where, you pretty much have to. So I think it will look quite a lot different. I think central London during the day will not go back to the footfall that we had before. I don't think there's much appetite for that because people are concerned about the risks of travelling. And also, of course, they've discovered that they can do things in a different way and that wasting all that time on the Northern Line is not necessarily the best way of spending your life.
All right, Sir Howard, thanks so much. Sir Howard Davies, there, chairman of NatWest Group, stays with us. So we'll talk a lot more also about possible negative rates if the Bank of England, if it's a possibility going forward. Coming up, London staff want big pay rises if they are to return to the office, as JP Morgan also offers Jamie Dimon $50 million to stay on for 5 more years. We'll talk about the banking and employment landscape next. This is Bloomberg.
think 10,000 hours is about what you need to master any subject. If someone comes in and has a regular, 8-hour-a-day job 5 days a week, it's going to take you about 5 years to have a base level mastery. On Wall Street, it's more like 12 hours a day, 6 days a week. That cuts you down to about 2.5 years before you become mastered in something. Once they've got that under their belt, they can then join a team. And if they've been successful going through the analyst program, joining a team, then the team will work through how that works. But it is a constant education each and every day.
Well, a war of words is being fought over the soul of banking. After 18 months of unconventional working habits, banking executives are divided over the best course for normalization within the industry. While Goldman Sachs and JP Morgan advocate a return to the pre-pandemic normal, European banks have shown far more willingness to promote flexible working. And what isn't being borne out in the desk space and rotas is being made up with greater compensation. Now, in a survey by Locate in the UK, they found that just 17% of London office workers want a full-time return to the office. But on the other hand, YouGov found that a cash incentive would convince 43% of employees to return. Now, banks in both Europe and across the Atlantic are already acting, with Barclays, Deutsche Bank and JP Morgan and others upping analyst pay to 6 figures. Well, let's go back to Sir Howard Davies. He's chairman of NatWest Group. And Sir Howard, I asked you a little bit about this, about whether you felt the need to pay some of your bankers a little bit more. But is there, if you look at the difference that banks and bankers have gone through since the 2008, has a culture changed much? I guess it depends on also where you view it, if it's, in the UK, Europe or the US.
Yeah, well, I should say, first of all, that we do have an investment bank, but we don't do M&A, we don't do equities. And our investment bank is a relatively small part of the whole. It's only 10 to 15% of our bank. So for the most part, we're talking about retail bankers, and we're talking about relationship managers of UK corporates all around the country. And that's a very different kind of ecosystem than the one you're talking about of huge trading floors where people are now trying to pull everybody back, because they do depend on interactions on the trading floors from hour to hour, minute to minute. A relationship manager dealing with 50 companies in the Midlands, it's not that kind of life. It really is very different. So first of all, you have to break down banking into what you're talking about. I think it's probably true that at the trading level and at the analysts who support trading, that the model of having those people together, close together, still works, is still important. We've had a trading floor operating through the pandemic. And so in that area, I can see that you want to try to get people back together as much as you can. But that is, of course, a relatively small part of what we normally mean by banking. And in other parts of banking, I think quite different considerations apply.
Sir Howard, we also heard from the Bank of England last month saying they were easing their dividend guardrails. I mean, how should banks approach this, given also the uncertainty of the pandemic and what kind of recovery we'll really see if we have to go back into a lockdown?
Well, the Bank of England, I think, have done the right thing, having done two, what in my view were questionable things. First of all, a dividend ban, which wasn't really necessary, and then some guardrails, which sort of took the judgment away from bank boards. I think the position is now where it should be, which is that banks have to think about what they believe to be a prudent distribution policy in the light of the current economic conditions and also in the light of the rules the bank sets and the stress tests, etc. And I think you can see, as the bank's report, Financial Stability Report, said last week, that on average, the UK banking sector has easily met the stress tests this time. And of course, this time, it isn't just a kind of desk exercise of a stress test. We've had a real one. And the banking systems come through that really quite well. So I think you can expect a lot of normalization of banking payouts. People will still be concerned to ensure that they've got a decent cushion above their capital minimum because of the uncertainty we've just been talking about how this recovery proceeds. So no one's going to be paying out down to the absolute minimum. But I think we will get back to a sustainable level of payouts in the banking sector. And I think that's important because during the last year, 18 months, a bit of a roller coaster ride for European banks. And European banks were hit quite badly, I think, by the dividend ban. the UK, but also perhaps even more in continental Europe. And that's not a good thing if your banks are all trading well below book. That makes capital raising, if they need to, very difficult. So I think we're going to get back to a pretty sensible state now, and sort of peace has broken out between the banks and the Bank of England on this.
Sir Howard, the Bank of England also asked NatWest and others to prepare, to be ready for negative rates, I think by August. Are you and other lenders ready if it were to happen? Or what kind of plans do you have in place?
Yes, in a technical sense we are. Of course, we've had to deal with negative rates ourselves in Ireland, where we have a bank, and that's been it's in the Eurozone, so that's been affected by negative rates as other Eurozone banks have been. So we have some practical experience within the bank. And I think we can technically manage it now. As for whether it's going to happen, well, we began our conversation by talking about the inflation risks. And clearly, even the Bank of England, which is still reasonably calm on inflation, there are a couple of members of the Monetary Policy Committee have started to talk about the need for some kind of tightening of policy, whether it's reduction of QE or eventually a nudge on the interest rate tiller. So I think while technically we've been preparing and we could do it, I think the prospect, the likelihood of negative rates in the UK has, in my view, diminished.
Diminished almost to how much? I mean, I don't know whether it's a 20% probability, and whether it seems that the next two to 3 months, maybe the next 2 quarters, are crucial to try and understand exactly what this economy needs.
Yes. No, I think that's a good point. And we will probably be much clearer by the end of the year. But unusually, of course, in the UK, you get these early indicators of a change in opinion on the Monetary Policy Committee because of our system, which requires every member of the Monetary Policy Committee to justify their votes on a month-by-month basis. And so they make lots of speeches. In fact, arguably, there's too much noise about monetary policy in this country. But what it does mean is that when there's a beginning of a change in trend, you start to see it earlier, rather than in the Fed's case or the ECB, you tend to get a surprise when they eventually decide to change their policy orientation. Here, you've got 2/9 of a chance of interest rates rising in the next few months because you've got 2 members of the Monetary Policy Committee who've suggested that their views have changed. Well, over the next 2 or 3 months, we'll see how that develops. It might go from 2 to 4, it might go from 2 to 0 again. But, it's quite interesting in the UK because you do get these early signs of a gradual change in focus on the Monetary Policy Committee. And that's why I think the probability of negative rates has fallen. I won't say to 0, but it has fallen.
Sir Howard, thank you so much. Always a fun conversation with Sir Howard Davies, the chairman of NatWest Group, joining us this morning. Now, coming up a little bit later this hour, more on the markets and what to expect from the ECB. We'll also speak to the BNP Paribas chief global economist. He's Luigi Speranza. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A former top fundraiser for President Donald Trump has been arrested on charges of illegally lobbying for a foreign government. Colony Capital founder Tom Barrack will remain in custody until a bail hearing, which is next week. A spokesperson says Barrack made himself voluntarily available to investigators from the outset and will be pleading not guilty. He recorded an exclusive interview with Bloomberg before his arrest was announced.
From my simple beginnings of where I came to have the gift and the opportunity to be next to a president of the United States, to have the honor of running an inauguration, to be up close and personal on some issues that affect the world order. I paid a personal price for it, right? The adversarialness of America and squaring off on both sides is something I still don't understand.
Now, COVID-19 is continuing its rampage through Asia, with South Korea and Thailand reporting record infections. Japan's top virus advisor says new cases in Tokyo could hit a record in early August before the end of the Olympics. Infections, meanwhile, are continuing to rise in Australia, despite a strict lockdown across much of the country. In the US, the CDC says the Delta variant now makes up 83% of all cases in the country, up from 50% at the beginning of the month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, Jamie Dimon's 5-year retirement joke just got serious. JP Morgan entices its chief executive. Stick around with a surprise award. Up next, we discuss that. This is Bloomberg. Stocks shrug off Monday's rout, with the S&P 500 posting the biggest gains since March. European equities lurch higher for a second day. Halting the exodus, more senior bankers leave Credit Suisse as JP Morgan dangles $50 million of stocks rights to keep the chief executive Jamie Dimon for another 5 years. Plus, Jeff Bezos blasts off to the edge of space and celebrates landing by giving away $200 million. We'll bring you our interview with the Amazon chief executive. So good morning, everyone. Happy Wednesday. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 21st of July. So Julius Baer reports its best first half on record. Rising markets and client inflows have fueled the Swiss bank's income from fees and commissions. As elevated trading activity related to the pandemic levels off, Julius Baer is also pushing deeper into UBS and Credit Suisse territory by seeking recurring business with the super rich. Well, the chief executive, Philipp Rickenbacher, spoke to my colleague, Manus Krani, and he expressed caution about a possible K-shaped recovery in the months to come.
We will be seeing, I'd say, vastly diverging patterns over the next 12 to 18 months. There will be some countries with great recovery rates. There will be others that will struggle much more. Maybe those who have been running more containment-based strategies will have a harder time getting out of this. I think, again, this is not over, and let's not chart a straight line.
Let's get straight to Manus Krani, who's in Zurich for us. Manus, what else did the chief executive actually tell you?
Francine.
And good morning.
Good to be with you. A very good morning to you. I brought you a very special backdrop again. Releveraging, but not excessively. And this is important. This is about the unleashing of demand, the K-shaped recovery, as Philip described. So there is a releveraging going on. There's that desire to borrow money, put it to work. He was even surprised by the level. He warned back at the end of the first quarter that things could get a little bit more difficult. But of course, Goldilocks is alive and rampantly well in these markets. These are record profits. You're seeing assets under management come to a target, of course, which he dispensed with, just under the 5% level. They doubled the net new money at the bank. But he does warn perhaps of a slightly more cautious stance, Francine. So it certainly sets the stage, I would say, for what's going to be a heck of an interesting week next week with Credit Suisse in terms of the numbers. Is Goldilocks, well, did she stop off on Bahnhofstrasse at Credit Suisse?
Yeah, I'm sure she did. I mean, I don't know. I can't even remember actually what Goldilocks did exactly, but I know she was a hero in many ways. And how does that tie in with how European banks will perform compared to their American counterparts?
Well, look, this is important because the backdrop to the European banking situation, if you think about equities, fixed income and M&A, a record M&A at UBS yesterday. The American banks, we have to be careful not to compare apples and oranges. The bulwark of American banks is investment banking. I looked at the equity numbers as well for the American banks. They traded nearly $11 billion in the quarter. The European peers will trade somewhere around just under $4 billion. So the US banks saw their equity business drop by about 18% quarter on quarter. Here in Europe and Switzerland, we expect a bullish quarter, up 32%. HSBC SocGen will be resplendent. One thing in these numbers in Credit Suisse next week that's going to be really critically important is how is their equity business doing? The estimate is for a collapse in the equity business of 70, 80%. Nobody really knows the result of Archegos, the result of deleveraging, the result of prime brokerage being deconstructed or pared back. So equities is the risk in Credit Suisse's number, to say the least. It's the least of their worries at the moment, because they have an amazing article written by my colleagues here in Switzerland about the culture in Dubai, the leadership in the Middle East, and really talking about people not necessarily wanting to stay at the institution, the deal makers, the people who bring business together. There are many challenges for that, so we need to be careful to compare like with like, Francine, in terms of the M&A engines of JP Morgan and Goldman Sachs relative to Europe.
Manus, thank you so much. Our Manus Cranney there live from Zurich for us. Now, let's also stick with the banking theme. Jamie Dimon's 5-year retirement joke has just got serious. Whenever asked about when he'll call it quits, the JP Morgan chief executive would usually quip that the date is 5 years away, no matter when he was asked. Now, as reality about succession sinks in at the U.S. bank, the JP Morgan board also decided to entice Dimon with a surprise award to make him stay for another, quote, significant number of years. Well, joining us now is Bloomberg's managing editor for EMEA Finance, Michael Moore, who for many years was also based in New York City. So, Michael, what exactly is this surprise award?
So it's basically a stock options grant. They're slightly arranged slightly differently, but this is similar to awards he's gotten in previous years, often many years ago. The idea is that he will benefit from the stock price appreciating, and could do so to a large degree. So this does seem to indicate that the board plans for him to be around for quite a bit longer. There was the leadership shuffle earlier this year that obviously brought succession into focus, but it does not seem that Jamie has any plans of leaving anytime soon.
So, Mike, what exactly is, anytime soon? Can we talk in terms of like 5 years? I mean, this is the big joke within the bank. Is it 5, 10 years? Or is it just, we'll wait and see?
Right. So these stock appreciation rights, he can't get them for another 5 years. He can't dispose of the proceeds for another 5 years after that. So this does tie him to the fortunes of the bank for a long time. Granted, he has had some health scares in the past. So you never want to say anything's definitive. But it does seem to put that 5-year timeline into a more formal relief.
Michael, speaking of staff retention, so Credit Suisse has lost yet another 4 senior bankers. So is the story behind the exodus just because of the scandals, or is it something, I guess, deeper?
So I think it's partly, the scandals obviously hurt the stock. A lot of these senior bankers are paid a good portion of their awards in stock. And it does, it sunk what was a very good start to the year for Credit Suisse. So that has raised questions about this year's pay. So, bankers are facing a hit to last year's pay and possibly this year's pay. And then, there are questions about the strategy of the bank. Does this make them shrink in investment banking? They have a new chairman who's taking a look, who's doing a full strategy review. So I think there are questions about, how committed will the bank be to this business going forward? So with all that uncertainty swirling around, and the other factor is outside of Credit Suisse's control. It's that we are in a boom on the M&A front, and there is a talent war going on, not just at Credit Suisse, but across the industry. And so you are seeing banks aggressively hiring to try to capture some of this boom.
Michael, thank you so much. Bloomberg's managing editor for EMEA Finance, Michael Moore. Now, coming up, former ECB President Jean-Claude Trichet warns on the spike in inflation. We'll get into the key risks with the BNP Paribas chief economist, Luigi Speranza. That's coming up shortly, and this is Bloomberg.
it is obvious that we have a very, very important spike on inflation, particularly in the US, I would say, and the US economy has a very, very important influential role in the world. So there I see clearly elements that are calling for vigilance and great attention.
Well, that was the former ECB President Jean-Claude Trichet speaking about the current inflation spike. Now, we're joined by BNP Paribas Chief Global Economist Luigi Speranza. Luigi, thank you so much for joining us. A lot of the focus is on inflation, but actually, if you look at inflation, does it all depend on lockdown, and is it just too soon to know what it will do even by the end of the year?
Good morning, and thank you for having me. Well, I have some sympathy with Mr. Trichet's words, actually. The shock is transitory in nature, but transitory does not mean short-lived. And the longer it goes on, the higher the chances of it translating in something a bit more persistent. And I can see some evidence of a change in mindset from both consumers and corporates. So I do think this shock is a bit more persistent than central banks are assuming.
And so what does that mean, actually? I mean, do you expect some kind of premature tightening that will be telegraphed to the markets, or is there a danger that that central banks are late to the game?
No, not at all. I think it's the latter. So no premature tightening. Central banks are likely to be late in the game. That's what actually they're telling us. I think an important shift in the Fed language has been the shift from outlook to outcome. So the Fed is telling us, I'm not going to move, I'm not going to tighten monetary conditions in anticipation of higher inflation, but I'll wait and see inflation. And I'll act when I'm convinced. There is some commitment here to be behind the curve, and that's what I think the strategy reviews are all about. And this increases the chances of inflation actually getting to target before they expect. But I don't think they will react to these signs of inflation. They will continue to say they are transitory.
Luigi, John Authers, which is one of certainly our favorite writers here at Bloomberg, wrote this morning about asset price inflation. He basically says equities might do better than bonds in conditions of rising inflation. They're still unlikely to do well in absolute terms. Whatever your view, John Authers says, on inflation, a shift away from the U.S. and away from the companies and sectors that have powered the U.S. seem to make more imminent sense. Now, I know, Luigi, you don't talk about markets, you're a chief economist, but how does it translate into your world? So who will power this recovery in the US, and is it different to who will power the recovery in Europe?
Yeah, look, I regard inflation as a good thing here, both in the US and in Europe. And I think the Eurozone will actually get also more persistent inflation like the US. And it's not a bad thing. I mean, our outlook here is positive for the economy and for risky assets. We're looking at a solid, sustainable recovery, despite some wobbles and some concern about variants, and an inflationary one, but it's domestically generated inflation. It's wage growth. Is profit margins, pricing power from returning to corporates. So I do think this has something positive and supportive over the medium term for risky assets.
So is the specter of deflation no longer a worry here in Europe? I mean, I had a good conversation with Christine Lagarde over in Venice at the G20, and she says, look, in Europe, it's just very different from the US. And I guess what economists are saying is that there's a danger that we're importing inflation from the US more than making it ourselves here in Europe.
Yeah, I absolutely see the argument, but my conviction is that we will also see wage growth, which in effect limits that risk. We will see higher ability of corporates to pass through higher input costs into final prices. So again, a sort of domestically generated inflation. And I would say the risks of deflation have diminished considerably. And the key element has been the policy support following the COVID shock. It's been prompt, aggressive, it's been effective. A big difference with the reaction after the global financial crisis, which I think in a way was a trigger of the low inflation we've seen over the past couple of decades. And now the kind of policy mix is much more supportive, appropriate, and I think conducive to inflation.
Do you think, Luigi, that the Bank of England will be the first to move? I mean, we saw a couple of hawkish moves from the New Zealand Central Bank, also, movements from Canada. Among the G7, who's going to be the first one?
Yeah, I think there is a case for the Bank of England to be one of the first. And one of the reasons is that the Bank of England has not changed its strategy, unlike the Fed and ECB, and it's not experienced that low inflation, unlike other economies. So we do expect a move sooner. When I say sooner, it's not imminent, though. I mean, we have the first rate hike for August next year.
All right, Luigi, thanks so much. Luigi Speranza, their chief global economist at BNP Paribas, joining us this morning. Now, coming up, touchdown. Jeff Bezos pulls off Blue Origin's first crewed flight to space. We'll bring you some of our interview with the Amazon founder, fresh from the space shuttle. That's coming up next. And this is Bloomberg.
Welcome back to Earth. How do you feel?
I feel really good.
Oh, my
Thank
goodness.
you. Really good.
Wow.
My brother Mark.
I mean, wow.
Yeah.
This is your first interview since landing.
Yes.
We all want to know the reality of seeing the Earth from above. Did it live up to the dream?
Beyond, honestly, I'm not talented enough to describe this in words. I can't figure it out. It was much more than I expected. It's awe-inspiring. It's just, I don't know. Do you have words?
I don't have words. It was truly, it was one of the most beautiful sights I've ever seen.
So now that you're here, now that you've accomplished this, what's Blue's next move? How does this fit into the long-term vision?
Well, the long-term vision, we're building an orbital vehicle called New Glenn. And this vehicle we just flew, New Shepard, is our suborbital tourism vehicle. So we're going to fly that over and over and over. And every time we fly it, it's practice for the orbital mission. And it gives people a chance to see what we just saw, which is this fragile, beautiful Earth that you can't imagine. People can tell you about it, but until you see it with your own eyes, I don't know, maybe we need to send a poet up or something, somebody who'd be better at describing it. What I can tell you is that it's just this thing that you can't tell. You can see that it's just one place. There's no boundaries, no national lines, nothing. The atmosphere, we see this thing, it's Earth's atmosphere. It's so big, we live in it, and it seems gigantic. But when you get up there, you see that it's actually this teensy little thing that we need to protect. So, I don't know, for me, it was definitely incredible.
Yeah, it was amazing. I was surprised at how easy it was to move around in zero-G. That was probably the most surprising thing.
Yeah, it felt almost normal.
It felt
like, it felt like we were somehow evolved to be in zero-G. It felt so good.
Yeah. So for the people here on Earth who are wondering, why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
Yeah, well, this is what we're doing is we're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far. And we have to keep it safe and protect it. And the way to do that is slowly over decades to move all heavy industry, all polluting industry out into space. That's what we're going to do so we can keep this planet the gem that it is. But to do that, we need reusable spacecraft. We need low-cost spacecraft. And to get that, we've got to practice. And that's what this tourism mission is about.
We saw your kids greet you on the ground.
Yeah.
I have 4 kids. For the kids watching, how do you want this to inspire them?
Well, they're going to, kids are all, every kid has so much potential inside of them. And what I hope that what we're doing a little bit is unlocking that. So for kids everywhere, the way you unlock potential is with inspiration. I was inspired as a little boy by the Apollo astronauts, and this is the next phase of commercial space development, and I hope that inspires little kids too.
Amazon's Jeff Bezos there, just returning from his trip to space. Don't miss a Bloomberg special at the space race. Alex Steele and Ed Ludlow will dive into the business of space. You can catch that from Friday evening if you're in the US, or Saturday afternoon here in London on Bloomberg TV and Bloomberg Quick Take. Now let's get a little bit more on this with our Bloomberg Intelligence Tech, Media and Telecoms analyst Matt Block. Matt, I mean, it was pretty, exhilarating, thrilling, but also risky to watch that yesterday. What are we going to see the future of space be? Is it for travel? Is it, as Jeff Bezos says, actually, do we even have the technology to start thinking about some of, the things that we don't want here on Earth elsewhere in the universe?
Yeah, I think ultimately that long-term vision will come to pass, but it is that long-term. So I think in the next few years, it's going to be much more around things like space tourism. Obviously, we've got missions planned to Mars in the next 3 or 4 years, both from the US and from China. So I think it's going to be more of these kind of regular, kind of shorter trips, if you like, but that's all part of this longer-term plan to look at how we can explore space more and use it to the advantage of Earth. But obviously our nearest planet, Mars, is some distance away. There's a 2-year window to get there. So the logistics, even if we find commodities that we can bring back to Earth on these planets, it's a very different process to how we do it on Earth.
So are you expecting actually, Matt, a lot more money going into this, or there are going to be a couple of venture capitalists being inspired by what they saw Richard Branson, Jeff Bezos do and pour money into it? Is there a piece of technology that actually we need in the next 12 to 24 months?
Well, I think there are lots of technologies out there, things like 3D printing, AI, they're all kind of really important in space, propellants. So I think there's already a lot of money going into it, and I think these kind of events we've seen in the last couple of weeks are going to inspire more venture capitalists, more investors to put money into this. There's a lot of SPACs looking to invest in emerging space companies. We've got an investment trust here in the UK that launched a couple of weeks ago. So I think there is a growing appetite to put money into this emerging industry.
Matt, where do you see this going in the short term? So, we had pretty exciting 10 days with those 2 billionaires going into space. Now, there's also a lot of questions about CO2 emissions. Is there a next appointment, must view, television viewing for someone else going into space, or is it going to slow down for the foreseeable future?
So the next big event, if you like, is in September when we see a similar trip from SpaceX, which is going to be the first all-civilian flight. And actually that's a bit different to these two because it's actually going to be an orbital flight. So we heard Jeff Bezos talk there about New Glenn. SpaceX already has with Falcon 9 and the Crew Dragon an orbital system, and they'll be spending, 3 or 4 days up there in space. That was a privately funded mission to the tune of a few $100 million. So that's something to watch for in September.
What does China think of all of this? If we're in this kind of big space race, are we going to see more Chinese or Chinese billionaires going into space as well?
Yeah, I'm not so sure about the billionaires possibly, but they're certainly investing as a nation state into space exploration. Yeah, they're competing with the US to be the first to kind of go back to the moon and build an established presence there. So I think the mid to late 2020s are going to be dominated to some degree by this tension between the US and China about that kind of milestone of a presence on the moon. And what that means kind of for future exploration beyond that.
Matt, thanks so much. Matt Bloxham there of Bloomberg Intelligence talking about space. Now, Bloomberg Surveillance Early Edition continues in the next hour. I'll be joined by Matt Miller out of New York with Kailey Leinz. We look at markets, we look at space. Of course, a couple of other things out there is bankers. We had this wonderful, surprising, I would say, maybe survey out of London saying that on majority, I think 75% of people want an extra £5,000 a year to go back into the office. This is Bloomberg.
The global supply chain is not working exactly as it should be. So that's one thing. So you see a bit of inflation there, but it's transitory, so it should not be a real concern.
We will be seeing, I'd say, vastly diverging patterns over the next 12 to 18 months. There will be some countries with great recovery rates. There will be others that will struggle much more.
The markets are very healthy right now, given the liquidity that has been infused all across. We had a recession that was 5 times greater than the average recession in 25% of the time, right? It happened so fast.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, July 21st. Our top stories today. To have and have not, Credit Suisse bankers are leaving by the dozens. Then there's JP Morgan, which will pay to have billionaire chief executive Jamie Dimon stick around a few more years. Promising a bright future, Netflix has suffered a slowdown the first half of the year, but the streaming giant says there's plenty of room to grow. And questions about a vaccine. A study finds that J&J's single shot produces relatively low levels of antibodies against the Delta variant. So good morning, everyone. There's quite a lot going on, Kailey, filtering through the markets after the down day on Monday. It's definitely a second day of risk on. We have some pretty encouraging data points here in Europe. We also have some encouraging earnings. But the overall question is still inflation. And of course, we look at Treasury yields.
Well, my overall question, Francine, is when are we going to see a dip in this equity market that isn't bought? Because, of course, we did see that dip buying coming in yesterday. And it seems that is following through today. You did have a mostly positive session in Asia. Sure, there were a few exceptions, one of them being the Hang Seng in Hong Kong. One of the big drags within that index actually was Tencent, which, along with other companies, was fined by the Chinese government for child exploitation. But other indexes were higher. China was higher. And the Nikkei actually up 0.6%, the first gain in 6 days. And of course, friendly reminder, the opening ceremonies of the Olympics are in 2 days. But one Japanese asset certainly not feeling the hype around that is the yen. Actually, your biggest underperformer in the Asian session, weaker against the dollar, now by about 0.2%. I also wanted to point to the Singapore dollar, which is at its weakest against the U.S. dollar since all the way back in September as you get stricter virus restrictions taking shape there. As for what the picture looks like here in the U.S., of course, it was the cyclicals that led the way as those dips were bought yesterday. And this morning, we are seeing futures on a firmer footing with about 4.5 hours to go until the opening bell. We're up about 18 points on S&P E-minis. In the bond market, which we are all watching very closely, we did see yields going back up above that 1.2% threshold yesterday. That lift in yields continues today, up another 2 basis points to 124. The dollar is stronger now for a fifth day, though it is off the highs of the session. And then I also wanted to point to Bitcoin because, Matt, it caught our attention yesterday for falling under 30,000. You had some technical watchers saying 20,000 is next, and instead we bounced back above that 30,000 level, trading just under 31,000.
Yeah, I missed my entry into Bitcoin. I slept through it yesterday. Look at the gains that we're seeing in Europe. I mean, big gains on the Iberian Peninsula, 1.9%. The CAC up 1.2% right now. The DAX gaining a little bit less than the rest of the continent, just about 2/3 of 1%. The interesting thing, though, is if you look at the euro and the pound, right now, there's very little change. Kailey, you were showing the Bloomberg Dollar Index. It was up this morning and then came crashing down in the last few minutes. So now we're not seeing a lot of movement. The euro dollar trading at 117.77, the pound at 136.22. The 10-year yield, and I think the Bund is interesting right now, still at negative 40 basis points, and the 10-year yield in the U.S. also is still at 118. So we're still seeing these what feel like rock bottom rates, Francine. This is one of the main questions I'm going to have for all of our guests today, not Andy Pekosz, but the other guests. You know, why do we continue to see rates basically telling us that there's no growth coming up? Or, I mean, you know, if they say it's technicals, I feel like it's been too long for that.
Yeah, I don't know. Maybe it is a question, actually, for Andy Pekosz, because it's all about the virus.
Yes.
What's interesting, Matt, is that, of course, the focus today is on earnings. I'm looking at a couple of the stocks, for example, ASML, Novartis up. And then there was, so the airlines in the UK, we need to talk about it a little bit more, actually challenged the government in explaining what this traffic system, amber, you know, colors if you want to travel. So they actually ruled in favor of the travel companies. Now, look at what else is ahead today. The ECB starting a potentially heated two-day meeting. Officials will debate how their 2% inflation goal affects policy. We'll also get earning results from United Airlines, Johnson & Johnson, and Verizon. And the IMF Managing Director, Kristalina Georgieva, speaks at a Peterson Institute event. Also, Elon Musk and Jack Dorsey will discuss Bitcoin at an event called The B Word. Kathy Wood will also be participating. Onto the banks, and the exodus is continuing at Credit Suisse. The bank has now suffered over 30 defections in the aftermath of the Archegos and Greensill scandals. Well, joining us now is Bloomberg's managing editor for EMEA Finance. He's Michael Moore. Michael, how big of a problem is this for Credit Suisse? Are we going to see more defections?
Well, I think the big problem for them right now is it comes during such a boom time for deals, and you see a lot of other competitors benefiting from that. So if they miss out on that, that could be a disappointment for investors. And we've seen a couple of analysts mention that possibility, that they'll be left out of this boom because of the internal strife and all the departures we're seeing. You know, the boom also means that everyone's looking for talent right now, and there's a lot of money sloshing around to poach people. So Credit Suisse's issues came at perhaps an inopportune time for them.
Michael, Jamie Dimon has been awarded $1.5 million stock appreciation rights. I don't really know what that means, but basically he's going to get a lot more money if he stays longer. He always says he's going to stay 5 years, at least 5 years from whenever you ask him. What's the deal with Jamie D?
Yeah, it does seem like this is setting him up to stay quite a bit longer. You know, the stock appreciation rights basically function like options. So could be, you know, if he's able to repeat the share price performance we've seen over the last few years, it could be quite lucrative for him. And, you know, I think this is, you know, this is a sign that he's not going anywhere anytime soon. I think there was a big succession discussion earlier this year when they did have the leadership shuffle. They are getting some of their top executives broader experience. You've seen it with Marion Lake and Jen Piepzak, who, you know, are seen as kind of two of the front runners in the longer term. So I think, you know, Jamie has said 5 years for about a decade now, but it does seem like this is these awards kind of match up with that timeline of 5 years from now.
All right, thank you so much to Bloomberg's Michael Moore. If Matt's going to call Jamie Dimon Jamie D, maybe I'll start calling Matt Matty M, Matty Mill.
That's okay.
Anyway, moving on to our next top story, a former top fundraiser for President Donald Trump has been arrested on charges of illegally lobbying for a foreign government.
Wow.
Colony Capital founder Tom Barrack will remain in custody until a bail hearing next week. A spokesperson for him said he made himself voluntarily available to investigators from the outset and will be pleading not guilty. He recorded an exclusive interview with Bloomberg before his arrest was announced. Here's what he had to say about being part of the Trump presidency.
From my simple beginnings of where I came to have the gift and the opportunity to be next to a president of the United States, to have the honor of running an inauguration, to be up close and personal on some issues that affect world order. I paid a personal price for it, right? The adversarialness of America in squaring off on both sides is something I still don't understand.
Kathleen Hunter, Bloomberg DC morning editor, is joining us now. So Kathleen, given how close Tom Barrack was to Donald Trump, does this damage politically the former president?
Well, certainly it's not a positive for Trump. That's pretty obvious. But I think that, you know, it's important to remember this is just the latest Trump ally, Trump associate to encounter some legal difficulties. Obviously, we saw Paul Manafort, we saw Roger Stone, both of whom were eventually pardoned by Trump. I think that it's worth noting that the former president, has been conspicuously quiet in the wake of these charges. There hasn't been a public comment yet. And so I think that that's worth noting, but I would imagine that eventually when Trump is asked about this and does talk about it, that he'll talk about it in the same type of context where he's going to, once again, most likely portray it as a political witch hunt against him. And so I think that's what I would potentially look for. And I think that for his supporters and the people that are in his base, this isn't really a game changer. So I don't know that the political fallout, especially this far away from 2024, is going to necessarily be that significant for Trump if he does decide to run again for president, or if, as we know he's going to do, he does try to influence the midterm elections. For instance, yesterday, Trump put out a statement related to Lynn Cheney, who is the, former Republican leadership member in the House who's gone against him on impeachment. He's looking to find a replacement for her in the House to back someone else in the primary. And I think that's really where Trump is looking to be right now, is to be a Republican kingmaker and keep his brand going in Republican politics.
No, absolutely. It will be pretty amazing, though, if Tom Barrack is really held in jail until next week. Kathleen, thanks so much for joining us. Bloomberg's Kathleen Hunter there covering Washington and the court system, I guess, for us. Netflix now had its slowest start to a year in nearly a decade. The CFO, Spencer Neumann, addressed growth concerns at the company.
There's still a bit of choppiness to our growth. You know, we had the kind of big pull forward in 2020 of subscriber ads. We also had the push in production of some of our kind of key returning titles and big tentpole new releases until the latter part of the year. But overall, the business is performing well.
Let's get more on this now with Matt Bloxham, Bloomberg Intelligence tech, media, and telecoms analyst. So, Matt, you know, Netflix has had a tough time, obviously, as the pandemic is over. Did they do enough during the lockdown to get those subscribers in and keep them for the longer term?
Yeah, I think so, but I guess the next 6 to 12 months can be quite critical. I mean, it's not surprising they've had a bit of a slowdown this quarter and next, and they're pointing to a much stronger slate of content, maybe in Q4 and into 2022. And historically, you know, big content releases have been what's really brought new customers in, so they need to grab the attention with those. And also, it's a tougher market now with people like Disney and Amazon out there spending billions of dollars on content too. The other interesting angle is the investment in games. This is quite an interesting connection with their plans to really monetize mobile in a bigger way. I think you're going to see the first of their games next year, and they're most likely going to be oriented towards their mobile platform. So that could be an extra source of growth that people get excited about, but it's going to be into next year before we see any kind of hard evidence of that strategy becoming a real part of the business.
All right, Matt Bloxham of Bloomberg Intelligence, thank you so much. Of course, Netflix fell as much as 6.5% in after-hours trading. It's only down about 0.3% in pre-market this morning. And as for a look at some of the other stocks moving in early hours here in the U.S., another stock that reported earnings after the bell yesterday was United Airlines. And the big news here is they are going to be profitable in the second half. It will be the first time in about a year and a half of pandemic-related losses, really benefiting from that domestic travel rebound, especially. That stock is up about 1.6% in early hours. Another stock that reported yesterday was Qualtrics, and really the big news here is that it raised its revenue guidance. As a result, that stock is up about 7%. And finally, I wanted to check on one of the OG meme stocks because it led a renaissance in those Reddit trader favorites yesterday. As a group, meme stocks had their best day since June. AMC was up 24%, a big contributor to that, and those gains are continuing this morning, up about 3.8% before the bell, Francine.
Kailey, thank you so much. I mean, I can't believe I've been watching so much Netflix. I thought that, you know, the Lacqua household would have given a boost enough, especially all those like French TV series like Lupin. Coming up next, we'll talk, inflation with Max Kettner, HSBC multi-asset strategist. And then a little bit later, Christian Keller, Barclays, head of economics research, also joins us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York City. Francine Lacqua joins us out of London. I have, yesterday, look, this is a chart, and I'll welcome all of our listeners on London DAB digital radio and just tell you all you need to know about this chart is we've climbed up on the S&P 500 to yet another intraday record high. But the interesting thing about this is the breadth is just not there. Only 52 or maybe 56 companies actually made a record high out of the 499 or however many are in this index right now. So it's really bad breadth with a D. You're not seeing everybody play along in this rally. And I think that's really interesting. Max Kettner joins us right now, multi-asset strategist at HSBC. Max, I was talking with Tom Keene yesterday. Should we cover tech more? Should we cover the FANG stocks more? You know, these are the companies that are really pushing us to these highs. It's not the value stocks. It's not the cyclicals, even though you would think they would in this reopening play. What do you think about the bad breadth that we've seen on the S&P 500?
Well, first, let's say pretty lucky it's bad breadth and not, not bad breath. I guess, look, it's not that much of an issue, I think, right? It really isn't that much of an issue. I think you've shown it in the chart as well. I think that was a one-year chart, and we've seen pretty bad breadth, actually, over the last year up until, sort of the end of the first quarter of this year, where, as you highlighted, it's been then more the value, the cyclical stocks that were taking over. Up until then, we've actually been pushing from, one all-time high to another with pretty low breadth and pretty much just a handful of stocks driving those gains. So I'm not, I know there's a couple of people really worried about this, about deteriorating breadth and, let's say the number of stocks making new all-time highs or number of stocks trading above 200-day moving average, whatever way you measure it. I know there's particularly equity people being concerned about this. I must confess, I'm not particularly sure if we look at the last 15 months and the rally in the last 15 months, whether looking at breadth is really a measure that would have helped you to gauge the rally. I think if you had followed that, particularly last year, that would have been a pretty losing trade, I guess.
So, Max, what's the right time to get out of equities? Or they just keep on rising?
Oh, good question. Good question. That's the $1 trillion question, I guess. My best guess is it's really not quite yet. What we really have seen over the last, I would say, 6-7 trading days is quite a bit of panic back into the markets. So, we were actually updating all of our positioning and sentiment indices this Monday. And we've looked at, after the sell-off, we looked at most of them have gone back to sort of neutral-ish levels. It's very far away from where we were just last Monday, actually. So not this Monday, but last Monday. So just 7 trading days ago, there was, we were really warning investors to say, look, most of our sentiment indicators are flashing red and be careful a little bit in the near term. But that's really changed. But from a broader perspective, look, macro is,
If that's on the equity side, what about on the side of the bond market? Do you think this was just short positions unwinding, or is this telling you something serious about growth that the equity market now needs to consider?
No, I think, there's a couple of things going on in bonds, right? So the first thing is, you mentioned it is positioning. Yes, we shouldn't forget that this is positioning in a pretty thin liquidity market, right? We've got the middle of July now, but it kind of feels like mid-August. So it feels like the depth of August in terms of liquidity. So that's what we shouldn't forget, that perhaps a couple of moves are exaggerated, number one. But number two, we also shouldn't forget, I do hear quite a lot of people saying, bonds are pricing in a recession now on real yields. What we really shouldn't forget is that there is an incredibly weak link between real yields and growth. So I'm not particularly sure where people are looking. That's not really what the bond market is pricing. What the bond market is pricing is lower terminal rates. It's basically pricing that the Fed, if it lifts off at some point, that they won't be able to get to the sort of levels, to the sort of 2.5% levels that perhaps is the longer run dot. But it has quite little to do with current growth, I would say, right? So that's what we shouldn't forget. And thirdly, which I think is underestimated, is an asymmetry between the bond and the equity markets.
Max, we'll have to get you back on to talk about that. Max Kettner, they're a multi-asset strategist at HSBC. Now, we'll have plenty more, of course, on the banks, on the markets, and treasuries. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller and Kailey Leinz in New York. I don't have FOMO at all. Now let's get straight to the Bloomberg. First word news, and widespread flooding in central China has forced the evacuation of about 100,000 people from a city known as the world's biggest production base for iPhones. Well, the city of Zhengzhou received 18 inches of rain from Monday afternoon through Tuesday. That was equivalent to about 8 months of the city's average annual rainfall. Senate Majority Leader Chuck Schumer is on track to fail in his attempt to start debate on an unfinished bipartisan infrastructure bill today. Well, Republicans say there's no way a deal will be reached in time, and they won't vote to open debate until there is text spelling out the agreement. And in sports, the Milwaukee Bucks have won their first National Basketball Association title in 50 years. Giannis Antetokounmpo scored 50 points to lead the Bucks to a 105-98 win over the Phoenix Suns in Game 6. Well, that gave Milwaukee a 4-2 win in the best-of-7 series. Well, Mr. Antetokounmpo was named the most valuable player. How did I do, Matt
You
Miller?
did well. You did well. I
Right.
think you did very well. That was not easy. You did very well.
There you go. We'll get back to the markets shortly with Christian Keller, Barclays head of economics research. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller and Kailey Leinz in New York. We're just poking fun at Matt Miller for having a Gryffindor tie. The Harry Potter theme is very strong with the Surveillance Early Edition. But the focus away from Harry Potter is also on the markets, on equities, Matt.
Yeah, equities having a real comeback in Europe. Right now I'm looking at, the DAX is a laggard, and it's up 0.9% in Frankfurt. Everybody else in Europe is outperforming the DAX. But my focus is still on rates. And I, talked to a lot of, buy-side guys and gals last night about rates. No one can really explain why we're seeing, for example, negative 40 basis points on bonds. We're still seeing just 124, and they're coming up, right, on the 10-year yield. It just doesn't make a lot of sense, and it's, I think, the question to ask outside of the COVID area, although, as you point out, Francine, it could well be related.
Yeah, and that's really playing out in the markets, Kailey.
Yeah, it is. We are seeing some dip buying coming in for a second day, some strong buying, especially in Europe in the travel sector. What is leading the stock 600 is travel and leisure. That index up about 3.7% right now. And of course, it was the cyclicals and reopening trades that led here in the U.S. yesterday. That does look to be the case again this morning, looking at futures trading, because you're getting outperformance once again from Russell 2000 futures, up about 0.9% after a 3% gain for that small cap index yesterday. Matt was talking about the action we're seeing in the bond market. I agree, it is very confusing. Is it real concerns about growth? Is it the fact that a lot of people were short, had to unwind those positions? Whatever the case, we are back above 1.2% right now, up 2 basis points on the 10-year to just under 125. But still, 125 is about 50 basis points lower than we were at the end of March. And speaking of that, the dollar has not been this strong since the end of March. It's interesting, the dollar spot index is off session highs, but still up for a 5th day in a row. And of course, I mentioned travel was outperforming in Europe. That does look like it will be the case here in the U.S. because in pre-market trading, some of your biggest gainers are indeed travel stocks. Cruise lines like Carnival and Norwegian, each up around 3%. The airlines gaining as well. American up 1.3% and Delta Airlines up 1.6%, Matt.
All right, very interesting to watch that reopening trade, and also the correlation that we've seen with that and 10-year yields. We'll continue to keep an eye on that. What I'm watching is negative debt, obviously correlated as well. We're back above 15, now almost to $16 trillion in negative debt. So this is a market that just doesn't want any yield for lending money to companies. Moody's and Fitch, Moody's or Fitch, I should say, were out a couple weeks ago saying they only think 1% of junk is going to default this year. So anyone who wants it can go out in the market and get money, and they don't have to pay up, which I think is really interesting with this chart.
Yeah, I love that chart. Negative yielding debt surpassing that 15 trillion mark. Now, the European Central Bank starting a potentially heated two-day meeting today. The central bank is facing a recovery-driven spike in inflation that it insists masks underlying weakness. Now, the former ECB president, Jean-Claude Trichet, also discussed inflation earlier on Bloomberg.
It is obvious that we have a very, very important spike on inflation, particularly in the US, I would say, and the US economy has a very, very important influential role in the world. So there I see clearly elements that are calling for vigilance and great attention.
Well, joining us now is Christian Keller. He's head of economic research at Barclays. Christian, thank you. Should we worry about inflation, or is it really transitory?
That is a big question, and there are a lot of different views. And I think what we can say is that we clearly see at the moment some of these bottlenecks and some of these short-term pressures to stay or having been more persistent than we thought. I'm personally surprised, and I think our research team is surprised about how complacent the market seems to be about longer-term inflation. It is true that there are good reasons to believe that some of the elements are transitory. In particular, if you look at certain items like used cars, etc. But the way the market is pricing long-term inflation now and how little it has been moved, despite some indications that some of the factors could be longer lasting, in particular in the labor market, I find that quite surprising.
Christian, I noticed you got your PhD in economics in Cologne. Of course, we've seen some of West Germany just absolutely devastated by flooding. At the same time, we're seeing California completely parched with droughts. How does this play into your picture of what's going on? I mean, these are, I guess, known unknowns that are hitting us. What do you make of the weather curveballs?
Well, I think one way to relate this to the question that was just asked earlier on inflation is that there's certainly in Europe, and I think in the US as well, and across the G7 world, a certain determination now to tackle climate change. We saw that in the G7 statement. And that could imply, and here we go back to inflation, that could imply, at least in the short run, significant cost pressures if we start pricing carbon, if there are a lot of more regulations in a way that make things more expensive. And certainly, and I think this is how Madame Lagarde saw it, that she thinks over the time there will be efficiency improvements, productivity improvements, and that could bring inflation down again over the longer term. But in the short term, and again, here we are back to inflation, there could be a lot additional inflation pressures from something that we have not seen before the pandemic, and that is the willingness and the drive to price carbon, but to do all types of measures to address climate change.
Christian, let's keep the conversation on Madame Christine Lagarde. What are you expecting out of the ECB tomorrow? How large of a shift are we really going to see?
Well, first I would say by seeing what the market has been doing in the last few years, or last few days, and how strongly now there's a belief based on the interview that Madame Lagarde gave that we see significant change. I wonder whether there may be some disappointment. We do think they will adjust their statement, and she has said so very clearly, to the strategy review. But we think a lot of the details that maybe markets already expect now will not be given until September or even December. But certainly there are certain changes they will do with regard to the 2% inflation target. That's clear. They have to adjust now, given what they said in the strategy review. And then people will be very alert about forward guidance on what happens to QE after the PEPP, the PEP runs out, about the timing of how long QE may last, and maybe also with regard to the limits, the self-imposed limits the ECB has given themselves on buying assets under the APP. Those are the issues, and there we may get some information.
But Christian, what exactly is the concern of the ECB? I mean, are we, do we have European inflation, or are we just importing it from the US?
Right now, I think what we see in Europe is some of the same factors driving inflation up that we see in the US. Some of the bottlenecks, that affecting the US on semiconductors and many other areas. We see energy prices, they have an effect on Europe. So I'm not sure this is imported inflation from the US. I think there's a global upward pressures on prices due to the reopening of economies after the pandemic. I think what is interesting, and here's a big difference possibly to the US, is the way the labor market acts. The US had a very different approach towards dealing with the labor market during the pandemic. Unemployment shot up, now it's coming down. We see wage pressures building. The question is, will those last in the next few quarters once a lot of the generous unemployment benefits run out? While in Europe, we had the furlough schemes, the short-term work schemes. So a lot of people never got unemployed, and they have to end these schemes, and then employment will probably rise. So it's a very different dynamic here in Europe than in the US.
Christian, thanks so much. Christian Keller, their head of economics research at Barclays, joining us this morning. Now, coming up next, Andy Pekosz, Johns Hopkins and Bloomberg School of Health professor and virologist. We'll talk about the J&J vaccine. We'll talk, of course, about the variants. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, NASDAQ President and CEO Adena Friedman. This is Bloomberg.
Now, the Delta variant now accounts for 83% of COVID cases in the U.S. That's according to the CDC. Now, this comes as Johnson & Johnson's single-dose vaccine produced relatively low levels of antibodies against the Delta variant in a study. Let's get straight to Andy Pekosz. He's Johns Hopkins Bloomberg School of Public Health professor and virologist, and he joins us now. Andy, thank you so much for joining us. Do you worry about the J&J vaccine? I know this is a preliminary trial and hasn't been reviewed by peers, but how efficient is it compared to an mRNA or to an Astra-Oxford one?
Well, we look at two different things as we look at vaccine efficacy. One is we can take serum from vaccinated people, bring it to the laboratory, and assess how those antibodies react with variants. And this study sort of shows that the J&J vaccine is inducing slightly lower levels against the Delta variant. We also have to look in the real world and see what the disease rate is in people who are getting the J&J vaccine. And so far, the signatures in the real world are that the J&J vaccine is protecting against severe disease mediated by COVID-19. So I think the signs are good that the vaccine is going to protect against those very severe cases, but it's something to keep in mind as we go forward and as the discussion about boosters come together. Whether or not the J&J vaccine is a candidate for boosters could be a discussion point for the fall.
So is the J&J vaccine one that the administration, as it continues to push to get more people vaccinated, should be using, or should we be favoring the two-dose mRNA vaccines like Pfizer and Moderna's?
Yeah, you know, the J&J has that advantage that it's a single shot. It doesn't have the cold chain issues that the mRNA vaccine does. It has the capability to be spread and used much more broadly and much more easily than the mRNA vaccines. So there is a place for the J&J vaccine in the COVID-19 vaccination program. I think as variants are emerging, we have to start having that discussion of, is it time to update the vaccines? Is it time to change the formulations at all to really match what's currently circulating? These vaccines were based on the viruses that circulated initially in the population. Things have changed dramatically from the virus side of things. So this may be a discussion now going forward into the fall about updating these vaccines.
How much longer, Andy, do we have to wear masks? I mean, I just flew from Zurich to New York. I had to wear my mask the entire time, which is annoying because I'm fully vaccinated and I tested negative before I got on the plane. Just like everyone else, I would assume. Is it really necessary? Is it virtue signaling?
I think we really have to think about when we wear masks is what's going on in your local neighborhood, what's going on in your town, in your city, in the case of travel, what's happening on a plane. We have not reached anywhere close to the really effective levels of vaccination where we should be seeing an effect on the population in general. So vaccines are working in terms of individual health. We need more people to be vaccinated in order to get that benefit on the population. If you're in a place where you're seeing a spike in COVID-19, particularly Delta, it's important to note that the vaccines are not 100% effective. You could still get infected, you could still get sick. So if you know that there's a lot of transmission in your neighborhood, something like wearing a mask is probably a good thing to do just to be prudent. If we can get our vaccination rate, particularly here in the US, up higher, then I think these issues of masks and other social distancing would go away, but we're not there yet.
Andrew, I mean, I think I was reading that Apple, it said that all of its retail service people should still wear masks. I mean, in the UK, we have 50,000 a day cases. It could go very quickly to 100,000. Does that mean that even if you're fully vaccinated, we should always wear a mask in the UK, given what you've just laid out?
Yeah, I think it's a matter of risk. So, for instance, here in Baltimore, our case numbers are low. Our test positivity rate is relatively low. It's starting to creep up, but right now, I don't have a concern as a person who's fully vaccinated in terms of not wearing masks. My workplace has a very high vaccination rate, so when I come to work, I also feel really confident that I'm not putting myself at any kind of extra risk. If you're at a workplace where you don't have a high vaccination rate, if you're at in one of the cities in the U.S. now that are seeing these massive spikes in Delta, your chances of coming into contact with someone who's infected are much, much higher. And in those cases, like I said, I think wearing a mask or practicing some social distancing, irrespective of your vaccination status, is an important thing that you can do to maintain your maximum safety.
Andy, thank you so much. Andy Pekosz there of Johns Hopkins, and the Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, the founder, of course, of Bloomberg LP and Bloomberg Philanthropies. Now, a little bit later today, we'll be also speaking with the Johnson & Johnson Chief Financial Officer. He's Joseph Woke. That's at 10 a.m. in New York, 3 p.m. in London, and this is Bloomberg.